The difference between the top 1% of traders and everyone else isn't their strategy. It's that they're still trading after 10 years, meanwhile 99% of other people have blown their account. The secret? They treat risk management like a religion, while everyone else treats it like a suggestion. In this video, I'm revealing the exact position sizing formulas and risk protocols used by traders who've survived every market crash, every losing streak, and every psychological meltdown. You'll learn why most traders risk 10 times too much, how to size positions mathematically, and the framework that turns emotional gamblers into systematic wealth builders. This isn't sexy, it won't make you rich overnight, but it will keep you in the game long enough to become profitable. And that's the only edge that matters. Let me show you the math that explains why 90% of people fail at trading. And it has nothing to do with their strategy. The risk of ruin is something that a lot of people kind of forget about or don't really care about nearly enough. Let's go ahead and talk about it really quickly. If you are risking, let's say 10% per trade, let's go ahead and show you what this looks like. You risk 10%. What do you think your risk of ruin is, right? The risk of you ruining your account and blowing everything up. Well, if you're risking 10% per trade, it's going to be a 95% chance of you blowing up. Not too sure how to really show you guys this, so I'm just gonna make it this. Yeah, there you go, you guys get it. 95% chance that's gonna happen. In other words, you lose all your money, which is not really what you wanna do. So if you're not gonna risk 10%, then how much should you risk? It's a really good question. But before that, let me go and show you what happens if you were to risk 5%. What do you think your risk of ruin would be if you're risking 5% of your account per trade or 5% of your maximum drawdown if you're gonna be using a prop firm? Well, it won't be 95%, but it will be 60% chance of boom. I don't know what the fuck that is. It's supposed to be an explosion. You guys get the point. So risking 10% means you have a 95% chance of blowing up. Risking 5% means you have a 60% chance. What about risking 2%? Well, if you're risking 2%, your chances are now down to 10%. This is just based off statistics, and it's surprising how quickly it actually drops down. Going from 10 down to 2 makes you go from 95 down to 10. In other words, your chances of you blowing up is very, very, very low compared to this, which has a very high chance. Now, why is it so easy for you to blow your entire account if you're going to be risking 10% of your total drawdown or 10% of your account? It's because it only takes 10 losing trades in a row and it's all gone. This is of course with regular risk management and not dynamic risk management, which I'll obviously be speaking about in case you're not aware of what that is or you don't know how to actually utilize it yet. But this is just a little reality check, a little bit of a reminder of why it's so important to risk accurately and to have a clear plan, or else you're putting yourself in a situation where, well, you might have a 95% chance of losing everything. So you're gambling. But here's what's crazy. Even traders who know this still blow up. Let me explain why. There's always going to be a gap between knowledge and execution. I'm sure you've said this yourself or heard somebody say it or whatever. It's something that you've thought of before. I'm so good at analysis, but I just can't trade for shit, right? I know what I'm supposed to do. My back test is good. I should be able to make money, but every time I go to place a trade, I get emotional, I get scared, I mess something up, I don't get the same results. And this is what causes problems, guys. It's psychology, and usually it's what's missing before, which is a lack of confidence and a lack of data and a lack of a clear plan for your risk management and such things, which allows you to have enough breathing room to actually fucking survive when things don't go well. So what's the actual solution to this? I mean, if you don't know the solution, you need to know why it's even happening to begin with. Why are you over-risking when you're in a losing streak? Well, it's probably because you're trying to recover all of your losses more quickly. In other words, to avoid pain, to avoid blowing up, but it's actually causing you to blow up because you're already down and now you're risking more. Meanwhile, if you are in a winning streak and you are risking more, it's because of greed, because you're looking to make even more, even faster. You feel like you're on top of the world. And usually, once you've gotten a bunch of winning trades in a row, that is when you usually lose a lot of your gains, where you go a little bit too, crazy, you get a little bit too confident, and you lose a lot of the gains, and it takes you a while to actually recover, and your whole confidence gets shot, compared to just maintaining good risk, staying level-headed, and being aware that based off your stats, you're probably gonna fall into losing streak soon, so you should prepare for it instead of just, I'll see what happens when we get there. Like I said, you got to find the solution. You got to figure out how are pros actually handling this? How are they handling these emotions? How are they preventing themselves from falling into these traps? It's very simple. They just have a clear plan to begin with. They actually know what they're meant to be risking based off their account size. What happens when they go into winning streaks, losing streaks? They've done hundreds of trades of back testing. They've done it all manually, so they know exactly what it feels like to place those trades. They've put in clear tags and they've made clear plans based off of that because they know, hey, on average, I get this many winners and losers in a row. This is my win rate. These are the statistics. And if this happens, then this is what I'm going to do, which means you already know ahead of time when you get 2 winners, well, you're going to be increasing your risk, but just by this much. And if you get a losing trade, you're going to reduce your risk to this much. If you go into a losing streak, you lose 4 trades in a row, you're going to make sure that you potentially take a few days off, you review everything, and you make sure to go back to your data, and you decide how much you're going to be risking based off the data you have. Ideally, you already know. You lost 3 trades in a row, this is what you're going to be doing. You're not supposed to be guessing every single time you're getting a win or a loss. You need to know exactly what you're going to do beforehand. It's the same with a trade. When you're actually entering a trade, you need to know, I will be doing this when this happens. I'm entering here with this much risk, and I will take my loss over here, and I will take my profits over here. Ideally with preset take profits and stop losses so that you're not squirming around trying to place it after you entered. Ideally, you always want to enter at the very least with your stop loss, and you can always just add your take profit a few seconds after you enter in case it's very time sensitive, your entry. So what exactly does the top 1% do differently? It starts with treating every trade like a business decision, not like a lottery ticket. Amateurs always focus on how much can I make. The reason why I'm making this video is for you guys to remember how important it is to actually focus on risk management first. As traders, we are risk managers before we are profit seekers. If you seek profit, you will fall into fear and greed. If you manage risk, you will not. In the end, you need to be focused in on statistics instead of hope. If you have your statistics and you know what your data is, and you're constantly refining it and making sure that it's all accurate in real life conditions, you're never gonna have any problems. If you have a clear plan with the right account size, the right numbers, you will be hitting whatever profit you're looking for, whether that's 5K or 50K or 500K a month from your trading. Whether it's manual or automated, you will hit your numbers so long as you're actually on top of it and you have a clear plan. But if you just download some random EA or just try this random YouTube strategy onto a random account, you're probably not going to be getting the results you want because you would have to get extremely lucky for it to fit exactly what your subconscious wants. Meanwhile, once again, how do you even know what you want? It needs to be clearly written, it needs to be clearly said. If you don't know how much you want to make, the market is going to decide that for you. If you don't know how much you're making per month, the market's going to show you what you are. Well, it's probably not going to be what you want. And it's not going to be repeatable, which is the main issue. Right? If you want to make this a true business and treat it seriously, it needs to be repeatable on a daily, weekly, monthly, quarterly, and yearly basis. Even on a 10-year basis, or else really you're not building anything. You're just burning through strategies and burning through accounts. If you want personalized help implementing professional risk management for your specific situation, you can book a call directly with me. We also have a totally free course that includes position size calculation and risk tracking tools. Both links are in the description. But keep watching because I'm going to show you the exact formulas that the pros use. Forget everything you think you know about position sizing. Here's the only formula that matters. 95% of traders have never even seen this. So Seb, what is this position sizing formula calculation? How do you do this? How do you know exactly how much to risk per trade? How do you know your lots? How do you know your contracts? How do you know how many points, how many pips? How do you know how to do all this? How do you know how to actually do this accurately and within seconds? Well, I actually don't. I do it automatically and I have software handle it for me. 95% of traders don't even really consider this to be possible, let alone even try. Yet everybody in my inner circle are doing it. They use a master account through software, which links to all of their slaves, which could be their actual brokerage accounts, their evaluation accounts, their funded accounts, and based off of whatever size, whatever leverage, whatever take profit stop loss, the sizes, etc., the kind of management they're going to be doing, and the amount and percentage they want to be risking, the whole system is automated. It's all done for you. You just place the trade with your entry, stop loss, take profit, and the rest of it gets done by software. Of course, you can do it manually, but it makes literally no sense to do that when there's many software that allow you to just focus on your actual execution and all of your risk is calculated for you. Of course, you need to have the right software to make this work, and the one that I use allows me to trade straight from TradingView, which makes my life 100 times easier, as opposed to using annoying ass platforms like Tradevate, NinjaTrader, MetaTrader, TradeLocker, CTrader, etc. A lot of these are good, but they're not great. But then again, position sizing is only half of the equation. Let me show you how win rate affects your survival. This might just blow your mind. When you have a 50% win rate, you should be expecting at the very least 7 maximum losing trades in a row. That sounds like a lot. Then again, that's why I say focus on having a good win rate and a steady risk to reward. If you don't have a decent mix of those two, you're going to fail. If one of them is way overpowered and the other one sucks, it's just not going to work. High risk to reward with low win rate is not going to work. Unfortunately, for just about any situation, unless you have a fully automated system, which doesn't require any human intervention, and a very high win rate but low risk to reward system is not going to work as well as you would like because, well, your psychology is still going to be coming in whenever you do have those losing trades. So that's why it's a lot better to have a balanced model that ideally has above a 50% win rate. I would aim for 70% through back testing testing and optimizations, and at least like a 2-to-1 risk to reward. If you can make that happen, you will be printing like never before. So how many losing trades in a row should you expect with a 60% win rate? Well, at least 5 in a row. And if you have a 40% win rate, yeah, you should be expecting at least 9 losing trades in a row. And that's once again just based off your stats, not even based off execution mistakes, any sort of issues with software, or the main one, psychological errors. It's always important to calculate your survival number. How much you should be risking should always be based off of your actual account size and your maximum drawdown. Like I've said a bunch of times before, you should not be risking randomly. Just because some random person told you that you need to be risking 1% per trade doesn't mean that's what you should be doing. The main thing that you need to be focused in on is figuring out how much should I actually be risking per trade based off of my account size. So if you were to have, let's say, a 100K funded account, right, with a 10% maximum drawdown, then should you be risking 1% per trade? What did we talk about earlier? If you risk 10% of your total drawdown, your chances are 95% of you blowing everything up. Now, have I told you guys before you could risk 10% of your drawdown? Yes, in my free course I talk about that, but only when you're actually experienced and you have the data to back that up. Most people are going to blow up because they don't have that data, right? The chances are just higher. But if you do have the data, right, and you are starting out, I still would not recommend doing 10%. I would recommend doing 5%. Your chances are going to be a lot lower to actually blow up because it'll take 20 losing trades in a row, which is statistically very difficult to actually reach if, once again, you're following your plan. But of course, if you can risk less, I would still recommend you risk less. Like I said, very different for a challenge account as opposed to a funded account. Funded accounts, you risk a lot less. With challenge accounts, you try to pass them a lot faster. I made a whole video actually talking about that, so go to my channel and you can find that video. The most simple formula you can use to anticipate these kinds of losing streaks and be prepared for them is adding 50% to whatever your maximum losing trades in a row is based off your data. So if it's maximum of 4 trades, then expect 6 losing trades in a row to account for psychological mistakes or for technical mistakes. With that, usually you'll be quite good. Of course, you could just double the number if you want to be really safe at first. It's going to make your psychology a lot easier. But honestly, if you just add 50% and you add dynamic risk management, you'll be totally fine. Theory is great, but let me show you how to actually implement this into your day-to-day trading. It's very simple, guys. Very simple. Like I said, if you've got a 100K account with a 10% maximum loss, you really just need to be able to do the math based off of this. If you have 5 losing trades in a row maximum that, well, you're typically getting based off of your data, then you just need to account for that. It's really that simple. So you're gonna have 5 max losers in a row, which means you should be accounting for more than that. 50% more would be right around 7, but you may as well just account for 8, right, in a row. So you're accounting for 8 losing trades in a row, which means you could technically risk 1% per trade and you'd be fine. I typically recommend having that number at first because it's just going to make you a lot more comfortable. So let's say you have a FTMO, 100K funded account with 10% maximum loss, right? It's flat right now and you're aiming for, let's say, a 5% payout, right? In this case, what you need to do to manage your risk properly to actually get to that number, obviously a lot of this is totally going to depend on your stats, your win rate, your actual losers, winners in a row, your risk to reward, so on and so forth. But let's go and just say that you have a 50% win rate with a 2-to-1 risk to reward on average, with 5 max losers in a row and with, let's say, 5 trades per week. In other words, 1 trade per day. This is what you could be working with, pretty simple numbers to be looking at. Now, how are you going to actually manage your risk in this kind of scenario? Like I said, you have 5 max losers in a row, you're going to account for 8. Then instead of risking just 1% per trade, you're going to be risking half. Why 1%? Because 8 is not 10. In other words, you could risk 1% and be fine based off your math, but even accounting for some extra losers, you might have some psychological things coming in, so I'd recommend risking half of that, which is going to be 0.5% risk per trade. Now, why 0.5? Why not 1? Because you're starting off. You'll be risking 1% per trade once you prove yourself after a month or 2, or after you get some consistent payouts and you notice no issues. If once you scale up, you start to find issues, then cut your risk a little bit, go back to normal, or start to raise it a bit from 0.5 to 0.75, and then just keep raising as you go. Totally depends on your data. Once again, if you prove to yourself you're only getting 5 maximum losers in a row, never more than that, your mistakes are very few, then of course you could change your risk, maybe do a little bit more than 1%, but you do need to apply dynamic risk management, which is what I'm about to show you. So let's say that, over 2 weeks, which is the minimum interval where you can actually get payouts with FTMO. So let's see if we can get a payout in 2 weeks. You have a 50% win rate. You're going to be risking 0.5% per trade. You have a 2-to-1 risk to reward and 5 trades per week. You're going to be taking, technically over here, 5 winners and 5 losers. What matters the most in the 5 winners and 5 losers is the actual string in terms of how how frequently you're getting the winners in a row and how frequently you're getting the losers in a row. So obviously we're going to go ahead and just give you an example, which is going to help you understand how well dynamic risk management can work. What I've said before in certain other videos and in my free course is that dynamic risk management can actually work in your favor whenever it comes down to your net result mathematically, but it can also be detrimental if you just look at the actual information, if you look at the actual number. The thing is, that's just the number. That's not the real number, right? That's theory versus practice. Practice will always be different, and typically it's going to work well in practice because it'll help with your psychology. So let's go ahead and say that we start off with a nice little 3 winners in a row. You have yourself 0.5, you have 1% profit, then another 1%, and then another 1%. Remember, because we're risking 0.5%, we are getting a 2 risk to reward, and we're going based off 5 trades per week and 50% win rate. So Monday, Tuesday, Wednesday, you have 3 winners, and you are now up 3%. You don't have your 5% for payout yet, so you're not taking that yet. All right, this is just an example. I would recommend taking a payout on this kind of situation. You could just wait the 2 weeks and you'll get a 3% payout, which would be 3K, and then you'd be able to scale into larger accounts with FTMO, and you'd also be getting your refunds, but I digress. Then you would be getting 2 losing trades in a row, which would be minus 0.5%, minus 0.5%. So now you have about a 60% win rate. So in this case, to balance it out, going into the next week, you would have another loss, minus 0.5%. And now in this case, you would actually be getting another losing trade in a row. So now we're at 1, 2, 3, 4, 5, 6, 7. And then you'd be getting 3 more winners, which I believe would balance this out, right? More or less. You have 1, 2, 3, 4, 5. So I'd be getting 2 more winners. And so let's say you have plus, well, I guess you do have the 5 losers in a row, so let's go ahead and just do minus 0.5, and then let's do plus 1%, plus 1%. So in this case, if you were to just do regular risk management, you would have 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. So you would make 5% here, you would lose 2.5, so you'd make 2.5% after everything else. 3 winners in a row, 5 losers in a row, and then 2 winners. Not too bad, right? This is something that can happen. In this case, you started off the week with 3 winners. In this case, you started the next week with 3 losers. You had 2 losers over here at the end of the week, 2 winners at the end of that week. It can flip around this easily. It can also just be back and forth, kind of like, 1 winner, 1 loser, 1 winner, 1 loser. But it's usually not that frequent, just depends on your actual stats. So this would be with regular risk management, regular, right? You make 2.5%. With dynamic risk management, things will be very different. In this case, after your first winner, instead of keeping your risk at 0.5%, you're now going to be risking what you just made. Your first trade, you risk 0.5% and you make 1%. Now you're going to risk what you just made on your trade, which means you'll risk 1% to make 2%. So now in this case, you would make 2% over here. Guess what you're going to do here? You're going to take the 2% and you're going to risk 2% to make 4%. Now in this case, in 3 trades, instead of making 3%, you effectively made 7%. That's even more than I thought. So you made 7%. Meanwhile, you actually didn't really raise your risk in a sense, because had you lost this trade over here, you would have actually just gone back to the previous level, right? You would have just gone back break even. Had you lost this trade over here, you would have just gone back to the previous level because you have a 2-to-1 risk to reward and you're raising your risk based off what you made in your last trade, which allows you to make 7% in 3 trades, which is more than the 5% we're looking for. That is the power of dynamic risk management. Now, of course, what about the losing trades in a row? In this case, you wouldn't even care about them because you'd already gotten your payout. But let me go ahead and just separate this as a different example. And let's just pretend like we just got 5 losing trades in a row, and then we get a couple of winning trades in a row so that I can show you how this works on the other end of the spectrum. You could easily start off with 0.5% risk per trade on your flat balance, and then you can start to apply dynamic risk management. So what you can do over here is start off with 0.5%, which means you're going to have minus 0.5% and another minus 0.5%. Why are we not changing our risk to the downside over here? Because our downside is very limited because we have a positive risk to reward. All we need over here after 2 losers is just 1 winner to make it back. So instead of changing per win, in this case, you're changing it per 2 losses based off this kind of example. Now, what happens after you get 2 losers in a row? Well, this is where things change. This is where you change it to 0.25% risk per trade, which means if you were to get another loss over here, 4 losing trades in a row, you would not lose 2%, you would lose 1.5%, which doesn't sound like a big difference yet, but if you were to risk 1% per trade flat and you lost 5 trades in a row, you would lose 5 out of the 10%, which is a 50% account loss. Big deal, all right? But if you were to do dynamic risk management, you would only lose maybe 2% or even less than that, right? Because you would be changing your risk based off of the actual losers in a row you're getting. Now, let's say you get another loss over here. And let's just say you get another loss, right? You got really unlucky over here. You make another little mistake. In this case, you just got 6 losers in a row. This over here is 1%. This is another percent. You're down 2% from 6 losing trades in a row. Like I said, massive difference, and it makes it a lot easier for you to execute. Why? Because you don't have as much psychological pressure. Because you know, if I just take another losing trade, I'll only be down like what? 2.25%, 2.5. Who cares? It doesn't even really matter, right? And so you don't even really care whenever you actually have that many losing trades in a row, because you know that your downside is limited. What happens if you start to get some winning trades here? Well, if you get a winning trade, you're risking 0.25%, which means you'd make 0.5%. Now, what do we do when we get a win? We do the exact same thing as over here. So now, if you were to get 3 winners in a row, let's see what happens. You are going from over here, risking 0.5% to risking 0.25% and having lost 6 trades in a row, which effectively has you down, I believe we said 2%, right? So this over here is minus 2%. You just recovered 0.5% because you made 0.5%. Now you're going to risk 0.5%, which means you're going to make 1%. So after 6 losers, you've just taken 2 wins, and now you've recovered, what is that, 75% of your losses. Get another win, you made 2% in this case. So you just made 3.5% in 3 trades after losing 2% over 6 trades. Do you guys understand the power of this? Do you understand why this is so important to use dynamic risk management? Not only just because of your P&L, right, which in this case would have made you 7%, right? And then over here, minimize all of these losses and then gotten you into the green right after, compared to this, which was only 2.5% after 2 weeks of trading, which doesn't even get you close to your payout. This is the difference, both for the downside and for the upside. You guys just need to have a clear plan and clear data to back it up. Don't just copy the numbers I just gave you. These will work for most of you decently, but actually choose your numbers based off of the stats and data you have. If you have no idea what kind of stats you have, if you haven't done that before, then check out my free course. I do explain it in a lot more depth, or book a call with me in the description where we can actually go over your plan and make one for you, and then see if you want to work directly with me so that I can help you implement it. Well, there you have it, the complete risk management system that separates the 1% from everyone else. You now have the formulas, the tools, and most importantly, the mindset to survive and thrive in any market condition. Your next video is essential, building a trading strategy that actually works. Because now that you know how to manage risk, you now need a strategy that's worthy of that discipline. I'll show you exactly how to develop, test, and implement profitable strategies that complement your new risk management system. Click the video on screen and let's complete your trading transformation.